Now I'll take you to an office setup to understand the meaning of planning and operational variances. Now this is happening in the month of December 2019. And as you know, December is a month where all the targets for the next year is finalized. So let's take a look at what they are discussing.
Your sales target for year 2020 is.
Now, in this case, is it possible for the sales representative to achieve this target, that is 10,000 units at a selling price of $50 for the year 2020? If he's selling some hand sanitizer, agree, the demand would shoot up. But all the other products, the demand has dropped. So basically, this target is unrealistic. It cannot be achieved by the sales representative. So always remember that whenever there is an uncontrollable factor, it is not right to compare the budgets and the actual results just like that, simply because the budgets are unrealistic. So we will have to first revise those budgets and then make a comparison with the actual results. Now, we have already studied about the basic sales variances. That was a traditional method of calculating the variances, where we did not consider any uncontrollable factors like COVID. So what were the variances that we had learned? There was a sales price variance wherein we compare the actual selling price with the budgeted selling price for how many units, for the actual units sold. And then we studied about the sales volume variance wherein we compare the actual units with the budgeted units. That is, whether we were able to achieve more or less than the budgets. And we multiply it with the standard contribution per unit if we were following marginal costing system, or we multiply it with the standard profit per unit if the company adopts absorption costing method. This was what we studied under the basic sales variances. Any doubts regarding this topic, I request you to refer to those two videos that I had mentioned in the beginning of the video for you to watch before attending this class. So this was a traditional method of calculating the sales variances. So I have copied the three formulas under the traditional method. That's the sales price variance, the sales volume variance under the marginal costing method, and the sales volume variance under the absorption costing method into the new slide. Now we will tackle the details that were given in the introduction. What was the sales target given to the sales representative? 10,000 units to be sold at a selling price of $50 per unit. So for the time being, we will ignore about the uncontrollable factors like COVID, and we will prepare the variances under the traditional method. Then we will connect it to the advanced variances. Now, whenever you have to calculate the sales variances, including the advanced variances, it is always better to adopt a format, because once we key in the figures in the format, it will be very easy for you to tackle the question. So right now, the format is something like this. You have the sales, that is the actual sales on top, and the original budgeted sales on the bottom. And sales, as you know, it is units multiplied by selling price. So we have the next column as units multiplied by selling price. So in the intro, it was said that the original budget was for 10,000 units and it is to be sold at a selling price of $50. This was before COVID. That is, it is the original budget. So against the original budget, we have to write 10,000 units multiplied by $50. And say the actual sales achieved was 7,000 units at a selling price of $30 per unit. So under the traditional method, we are supposed to calculate the sales price variance, that is a difference between the selling prices, and the sales volume variance, that is a difference in the quantity. So first we will calculate the sales price variance. Actual selling price is $30, budgeted selling price is $50, and actual units sold is 7,000 units. Substituting the figures in the formula, we get the variance as $140,000. And it is adverse because the actual selling price is lesser than the budgeted selling price. We reduce the selling prices. Or you can also say that if you get a negative answer, it is an adverse variance. Now coming to the sales volume variance according to marginal costing system. Usually in the question, the standard contribution will be given. Now, please note that it is the original standard contribution which has to be taken in the formula. Now, in the question, there will be so many distractors saying that the contribution has to be revised. The direct material cost has increased, the direct labor cost has increased. Don't get carried away by all those distractors. Always take the original standard contribution in the formula. So the original standard contribution given in the question say it's $45. So what is the sales volume variance? The sales volume variance is actual units, which is 7,000, minus budgeted units, which is 10,000, into original standard contribution, that is $45. So substituting those figures in the formula, we get the variance as $135,000, and it is adverse because the actual units sold is less than the budgeted units. We were not able to achieve the target. Or you could also say that when you calculate, if the answer is negative, it is an adverse variance. Now, the sales volume variance according to the absorption costing, the only difference is that we have to substitute it with the original standard profit as against the original standard contribution when we did the marginal costing system. That's the only simple difference. And in the question, instead of the contribution, it will be the profit that will be given. So in today's class, I will not be calculating the sales volume variance according to absorption costing system, because that you can easily do on your own. That is, instead of contribution, just take profit for sales volume variance. So what we have just done is the sales variances according to the traditional method. Now we will go to the advanced variances. Now, when should we calculate these advanced variances? It is when there is an uncontrollable factor. Now, if you see that the original budget was for 10,000 units and we could achieve only 7,000 units, but we know that COVID is the reason because the entire market demand has reduced. So can you blame the sales representative for these adverse variances? So basically, for control purposes or for evaluating the sales department staff, it is essential that we revise this original budget. Only then we can compare it with the actuals. So what I'm going to do is, instead of comparing the actual with the original budget, we have to compare it with the revised budget. So I'm going to place the revised budget in the center. So what is to be done? The actual has to be compared with the revised budgets. Only then the evaluation will be proper. Now, when we compare the actual results with the revised budget, it is known by the name operational variances. What do you mean by operational variances? All the variances that has resulted because of the operations of the company or because of the efficiency or inefficiency of the sales department. That is basically due to factors that were controllable. And when we compare the revised budget with the original budget, that is known as the planning variance. This is because of uncontrollable factors like COVID. So planning variance is the variance which is calculated due to the defect in the planning. Now, in the question, it is given, due to COVID, market size dropped by 50% and other companies reduced their selling prices to $40 per unit. So immediately we should understand that the budget has to be revised. So instead of 10,000 units, since the market size has dropped by 50%, the target or the original budget should also drop by 50%. So in the revised budget, the units will be 5,000 units only. That is 10,000 units multiplied by 50% because the market size has dropped by 50%. That is how I got 5,000 units in the revised budget. And since all the other companies have reduced their selling prices to $40 per unit, even our company has to reduce the budgeted selling prices to $40 per unit. So that is why the revised budgeted selling price has been taken at $40 per unit. So first we will calculate the operational variance and planning variance relating to the sales price variance. So it is quite simple. All that we have to do is we have to split this 140,000 into the operational part and the planning part. Now listen carefully. What have we done under the traditional method? We have compared the actual selling price with the original budgeted selling price. That is 30 and 50 was compared. Now, in order to find out the operational variance, we have to compare $30, that is the actual selling price, with the revised selling price. That is the only difference. So the calculation will be $30 minus $40 for the actual units sold. The item that appears outside the bracket, that is actual units sold, don't change. So we get the operational variance as $70,000 adverse, because as per the revised budget, we were supposed to sell at $40. But at what rate did we sell? We sold only at $30. That is, we reduced the selling price even further. That is why it is evidenced by an adverse variance. Here again, when you solve this, if you get a negative figure, we can understand that the variance is adverse. So as a formula, if we have to write the operational variance, it is the actual selling price, that's $30, minus the revised budgeted selling price, that's the $40, multiplied by actual units. So that is 7,000 units. Now moving to the planning variance. In planning variance, what are we trying to find out? As per the original budget, the selling price was $50, but we were forced to reduce it to $40 due to COVID or any other uncontrollable factor. So we are trying to find out how much loss we have suffered because of that reduction. So always take the top figure first, $40 minus $50. That's the difference in selling price. And I said always outside the bracket, it is actual units sold. So let's write the answer. It's $40 minus $50. That's the difference in selling price multiplied by the actual units sold. So the answer is $70,000 adverse. And why is it an adverse variance? Because we were forced to reduce the selling price due to COVID. So we are suffering a loss on that account. Now here again, if we are to write the planning variance as a formula, it is revised selling price minus the original budgeted selling price multiplied by actual units sold. So always remember, outside the bracket, it is always actual units sold. It is only inside the bracket that we have actually made a split of the selling prices. So if you notice here, the sales price variance according to the traditional method was 140,000, split into the operational variance 70,000 and planning variance 70,000. So the total matches with the $140,000. So our answer is right. Now let's move on to the sales volume variance according to the marginal costing method. So here, as per the traditional method, what did we do? We compared the actual units with the original budgeted units, that is 7,000 minus 10,000, and we multiplied it with the original standard contribution of $45. So that was under the traditional method. But due to COVID, the market demand itself dropped. So it is not right to compare the actual units with the original budgeted units. So that is the reason why we have a revised budget here, 5,000 units. Now coming to the operational variance part. We have to compare the actual units with the revised budgeted units, because only then the evaluation will be correct, because 5,000 units is after taking into consideration the dropped demand due to COVID. So in the original formula, what did we do? It was actual units minus budgeted units, that is 7,000 minus 10,000. In the operational variance, we will compare 7,000 and 5,000. So the answer will be 7,000 units minus 5,000 units multiplied by the original standard contribution of $45 per unit. Always remember, whatever is outside the bracket will remain as such. Please don't change that. Even if the question says that the contribution has been revised. Always, operational variance and the planning variance is calculated based on the original standard contribution. Because we are trying to find out what is the variation cost from the original budget. So the answer works out to 90,000 favorable. And why is it a favorable variance? Because when we adjusted the COVID drop in demand, the revised budget is only 5,000 units, but the sales department achieved a sales of 7,000 units, which is much above the revised budget. And hence, there is a favorable variance. Even if you look at the formula, we have ended up with a positive balance. And hence, we can confirm that it is a favorable variance. Now, if you have to write this as a formula, it is actual units minus the revised budgeted units multiplied by the original standard contribution per unit. Now moving to the planning variance. In planning variance, what are we supposed to find out? What is the defect in planning? Instead of 10,000 units, we were supposed to plan only for 5,000 units. So that is a difference that we are trying to find out. So the planning variance will be 5,000 units minus the 10,000 units. Always take the top figure first, multiplied by the original standard contribution of $45 per unit. So the answer works out to $225,000 adverse. Why is it an adverse variance? Because prior to COVID, we had budgeted for 10,000 units, but unfortunately, we can't achieve that target. We had to revise it to just 5,000 units. So there is a reduction in profit due to that reason. And even if you look into the formula, we have ended up with a negative balance. And hence we can confirm that it is an adverse variance. Now, if you have to write this as a formula, it is the revised budgeted units minus the original budgeted units multiplied by the original standard contribution per unit. So let's cross check our workings also. 225,000 adverse variance less 90,000 favorable operational variance will give $135,000 adverse, which is the total sales volume variance under the traditional method. So since the totals are tallying, our answers are right. Now at this point, I want you to understand the meaning of two words, and those are the market size and the market share. Market size is the total customers in the market. And what is market share? Market share is the percentage of customers buying the company's products. Planning variance is also known by the name market size variance. The operational variance is also known by the name market share variance. And as I already said, what we have done here, the sales volume variance is according to the marginal costing system. If in the question, it is the absorption costing that the company follows, then immediately substitute the original standard contribution with the original standard profit per unit. So whenever you get a question on planning and operational variances relating to sales, the first thing that I want you to do is you have to take note of the original standard contribution from the question. Either it will be directly given or we will have to do some small calculation. What is contribution? It is selling price minus variable cost. Or sometimes in the question, it will be standard profit that is given. So immediately take note of that. Or you might have to do a small calculation. What is profit? Selling price minus variable cost minus the fixed cost per unit. So do that small calculation and take note of it. And what is the next thing that you have to do? Always arrange the data from the question in this format. That is, the actual sales should be split into the units and the selling price at the top. In the middle, you have the revised budget again with the units and the selling price. And in the bottom row, you need to key in the original budgeted sales, that is as units and as the selling price. So once you have the data in this format, you will be able to find the answer in a jiffy. Now, in certain questions, the actual units and the revised budgeted units will not be directly given. So let's take a look at those question extracts. Now, say in the question, the original budgeted units given is 10,000 units, and they have further stated that market size increased by 50%. Then how do you calculate the revised budgeted units? Now think for yourself. When they have said that the market size increased by 50%, it means that the number of customers that are coming into the market have increased by 50%, which means that instead of budgeting for 10,000 units, we can easily add 50% to it. What is 50% of 10,000? It is 5,000, right? So 10,000 plus 5,000 units, we can easily take the revised budget at 15,000 units. Now writing this using the percentage, we get the revised budgeted units as original budgeted units multiplied by 150%. Why 150%? Because 50% is the increase. So in order to get a revised budget, we have to multiply the original budgeted units, that is 10,000 units into 150%, that is 15,000 units. So we get the very same answer. Now we move on to the second type of question. The overall market demand contracted by 5%. In the first case, it was increased. In the second case, they have said contracted by 5%. Contracted by 5% means reduced by 5%. So how do we find out the revised budgeted units? Revised budgeted units is 10,000 units, that is the original budgeted units, multiplied by 95%. Why 95%? It is 100 minus the drop of 5%. Okay. In the earlier case, it was 100 plus the increase of 50%. So we get the revised budgeted units as 9,500 units. Now, in the question, they have further stated that market share improved by 2% to 22%. This is a tricky thing. So listen very carefully. They have not given the actual units in the question. But from this sentence, we are supposed to find out the actual units. So the calculations of the tricky part I will indicate in blue. Now, what have they said? Market share improved by 2% to 22%. So the revised market share is 22%. And since the increase was 2%, what was the original market share? It is 22 minus 2 or just 20%. So we will just write that. So the revised market share is 22% and the original market share is 22 minus 2 or 20%. Now the original budgeted units of 10,000 units is always calculated on the original market share. So it is very easy for us to find out the original market size because 20% of the original market size will be equal to 10,000 units. What is this 20%? It is the original market share. What is this 10,000 units? It is the original budgeted units. That is, the original budgeted units is 20% of the original market size. So what is the original market size? The original market size is 10,000 multiplied by 20 by 100. When it is taken to the other side of the equation, it is 100 by 20, or the original market size is 50,000 units. In the question, they have said that overall market demand contracted by 5%. So what is the revised market size? The revised market size is 50,000 units. That's the original market size multiplied by 95%. Why 95%? Because the contraction is 5% or the market size is reduced by 5%. So it is 100 minus 5 that we have to take. So the revised market is 47,500 units. Now coming to the actual units. Now, what is this revised market share? Revised market share is the share that we have in the market presently, which means that we got the revised market share from the actual units only. So the actual units is the revised market size of 47,500 multiplied by the revised market share of 22%. So we get the actual units as 10,450 units. So in this case, in order to find the actual units, we have to adopt a three-step process. First, we have to find out the original market size. Then we have to find out the revised market size. Then only we can find out the actual units. So this is the tricky part that you have to keep in mind. Now, we all know that planning variance is a result of the uncontrollable factors, but competition cannot be treated as an uncontrollable factor. Because if we treat competition as an uncontrollable factor, then it is very easy for the sales department to shift the blame to the increase in competition. That can just not be done. They should be efficient enough to withstand the competition. So, if competition is given in the question, add the sentence, the manager should be partly held responsible for the drop in sales due to competition, as he is expected to have countermeasures to prevent the drop in sales. So that's it about the planning and operational variances relating to sales. Stay tuned for the recap ahead.